Do these steps if your fixed rate mortgage is ending in 2023. So, do you have a fixed rate mortgage? Is it ending in 2023? It's quite potentially you're facing some significant increases in your mortgage repayments in 2023. So, in this video, I'm going to share with you how you can understand the position you're in and how you can limit the pain of the increased mortgage repayments you may be facing with your mortgage ending in 2023. So, hi, welcome. I'm Michael Sgarbossa. Welcome to my channel, Save, Invest, and Grow Your Money, a channel I created to save tips and strategies, low risk strategies to help busy people get ahead in their finances and create wealth for yourself and your family. So, back to the subject at hand today in regards to fixed rate mortgages. So, here in Australia, in the current Aussie market, the Reserve Bank of Australia estimates that about 23% of all Aussie home loans um, are going to that are fixed rate Aussie home loans are going to expire in 2023. Now that's massive. What that means, that's about every 1 in 4 homeowner in Australia has a fixed rate mortgage. It is going to end this year. That is significant. It's a big problem. It's going to be a massive problem, and it's going to have a massive impact on household finances and spending, and the repercussions for the housing market could be actually quite significant. So you need to be prepared if you're going to be one of these people. So 1 in 4, remember, so it's a high chance this could actually be you. So I'll just share my screen. So is your fixed rate ending? You need to understand, is your fixed rate ending? Know when it's ending, know what that standard variable interest rate your mortgage is going to default to, and know how much your repayments increase are going to be. And it's going to be significant. So once a fixed rate mortgage ends, it defaults to the standard variable rate, which is in your mortgage product. Now you can find this out by looking at your mortgage papers that you would have received with your mortgage, or just ring up your bank and ask them. They'll be able to tell you this. Now, it is likely that standard variable rate is going to be at least it's quite a big range, could be between 2 and 5% above the current Reserve Bank of Australia base rate right now in January. That is 3.1%. And in February, it's likely from all reports in the media that we're going to be facing another 0.25% increase on top of that. So it's still going up. Now, what this means is when your fixed rate loan ends or expires, defaulting to that standard variable rate means that your interest rate is probably going to increase to about somewhere between 5-7%, maybe even higher. Now, what that really means, if you're on a fixed rate of 2 or 3% at the moment, which is highly likely, that's going to be at least doubling your repayments. Can your monthly budget afford that right now? That is significant. Okay, so you need to really find out, know when your fixed rate's going to end, what the interest rate is going to be, and more importantly, what the repayments are going to be. And then you can have a look at your monthly budget and work out what is going on there. So you got to understand, can you afford this increase? You need to get prepared. Waiting for the day of the event to happen and getting a rude shock in that month is not going to work too well for you, I don't think. So you need to start looking at how to adjust your spending and create some margin in your spending right now. So understand what your current monthly financial position is, understand how much you're spending a month, understand how much income you're getting a month. Hopefully, the difference between your income and your spending is a positive one. So that is you're spending less than you earn and you actually have some savings and you're putting some savings away every month. So I pray that that's the situation. If it's not, then what I'm about to tell you will also help with that problem, hopefully. Okay, so the first thing you need to do is, well, how much are you currently saving? Because that's the first little buffer. If you currently got savings, then you might need to start rediverting some of those savings into paying your mortgage when your mortgage repayments increase. So that's the first thing to keep in mind. If you're already doing that, that's great because you've already created some or maybe all of that buffer for yourself and you're in a good position. Now, the next thing you can do is review your big ticket expenses. So what do I mean by that? I mean expenses such as your home and vehicle insurance policies and probably your energy bills. They're the the few areas that you can really have a look to, and maybe actually get some pretty big savings pretty quickly. So, with your insurances, the first thing I would do is contact your insurance provider and ask them if they're actually giving you the best deal. Because it could be well and truly right then they'll go and have a look and go, "Oh, actually, we could probably give you a bit more." Classic case, if you don't ask, you don't get. Because they'll have in the back of their mind, okay, well, they've asked if we can give them some more, we will. Otherwise, it's potentially they're going to go to one of our competitors and we'll lose their business. So they're already thinking that. The other thing you could do as well to get peace of mind is get your current insurance policies around your home and your vehicle. Go and have a look on, search the internet, have a look at things like CanStar is a good place that will recommend different insurers. Ring up those insurers, provide them with your policy. Ask them if they can give you a quote and beat what you're currently on. That's another way you could do it. And also have a look at the excesses that you're up for should you need to use your insurance policy. So a lot of people have quite low excesses, like a few $100s. Now, if you can afford a higher excess, maybe around your home insurance, instead of it being $400 or $600, maybe you could afford 14 or $1,600 excess should something go wrong. And these are rare events, of course. How many times you've actually claimed on your insurance? So I'm guessing it's probably very little or none. So think about that, because if you increase your excess, that can quite often result in fairly large savings on your policy, annual policy premium. So have a really good look at that. Now, also the other thing I mentioned was energy deals. Now, here in Australia, there is a government website called energymadeeasy.gov.au. I'll put the link in the description of this video so you can go there and have a look. I've also previously done a detailed video on this website on how to best navigate it and get yourself a result. And what this website is, it's a brilliant website. You put in all of your energy details of your current bill. The website assesses if you are currently with the best energy provider for you and on the best type of deal. So if you're not, it will recommend a change and then you can go from there. So very, very good website. Sadly, if you're a Victorian or Western Australian, it's not going to work for you. For some reason, those states aren't covered in this website. So sorry, guys. But yeah, go there and have a look. Like I said, got those links in the description of this video for that website and also my previous video on that. So, and the other thing you can do is just have a look at where you're spending your money every month. There are some discretionary expenses there you could probably reduce or put on hold for a season or two to help you through this tight time of increasing interest rates. So things such as, streaming, entertainment streaming sites, Netflix, Disney Plus, Apple TV, the list goes on. You may have subscriptions of multiple of those. Maybe you could cut a few of those back and just stick with a couple of favorites or a favorite for a while. That's an opportunity. Maybe you're on Foxtel. I know Foxtel's pretty expensive and most of it you probably don't watch. So maybe you can ditch your Foxtel and just get Netflix or Apple TV or something. That might be a consideration. Even for the guys, a lot of guys in Australia love their gambling apps. Maybe stop the gambling apps for a little bit. I think that would be highly recommended. My opinion is stop it forever. Gambling is just a very expensive form of entertainment and just such a waste of money. I don't really subscribe to that. But everyone gets their kicks from different things. But there's some things to have a think about. Now, the next thing you could do is renegotiate or refinance your current mortgage. So whatever you do, if you can avoid it, do not stay on the default standard variable rate once your fixed term expires. Okay, in most cases, you can definitely get yourself a better deal than that standard variable rate, without a doubt. And I would suggest, probably 1% to 2% is possible. You would have to really, it depends on your circumstances. Now, I have actually done another video previously where how to contact your lender and renegotiate for a better interest rate. So I'll also leave the link for that video in the description of this video. Maybe you could go check that out. And I go into a fair bit of detail there. Now, I'll just do a quick summary on this. So, I would suggest contacting your lender or your mortgage broker if you use one, or if you want to use a mortgage broker. Discuss your options when your fixed rate expires. That's a really good thing to do. Your goal is to renegotiate your fixed rate mortgage when it ends to a mortgage product that will be less than that standard variable rate that you will be facing. So don't pay it. Avoid that if you can. Now, of course, when you start going down this path, and if you've already got a mortgage, you probably remembered this last time, it can be pretty confusing to navigate all the different mortgage products that are out there. So, they're all offering different aspects, such as establishment fees or no establishment fees, or ongoing annual fees or no annual fees, or a discounted interest rate for the first maybe 6, 12, 18 months of that mortgage, and then it steps up. There are quite a few different things that mortgage providers do here to attract your business. Even more so at the moment, because the banks are realizing that 23% of people are facing this problem this year, and there is a lot of competition in the market for your business if you have a mortgage. So there are a lot of banks at the moment throwing around great cashback offer deals, and I mean cashback in the thousands, so up to $5,000 is some of the things I've seen. So they can be pretty good to attract you, but just beware of the terms of those loans, right? So you may be able to get one with a great cashback deal and great terms, but just don't be fooled by some of these great big cashback offers, because the terms of the loan might not be so favorable for you down the track. So what you really should be doing is taking into account all of these different loan costs and factors to understand the overall cost of the loan over the long term, to see what product actually gives you the best value. Now, the way to work this out is there's something called the comparison rate. If you ever go on any of the comparison websites like Rate City or CanStar, legally, mortgage providers or lenders in Australia have to provide a comparison rate. So you'll see this with any mortgage product. What that comparison rate is that it includes most of these costs as a comparator between different mortgage products to help you make a decision on what loan offers the best value over the life of over the long term. So that comparison interest rate value includes these different costs to help you get a direct comparison between products. Okay, so I'd recommend actually using a mortgage broker to help you with this. I certainly use a mortgage broker for all of my loans. I love my mortgage broker. He's great. He provides an awesome service, gets me great deals. I'm happy to actually recommend my mortgage broker. If you really want to have that access or have that introduction, just leave me a comment in this video and I'll get in touch with you and provide that introduction. Now, the last thing I'm going to touch on before I leave you today is there is potentially another big issue that you're going to need to avoid. And I call this the LMI mortgage trap. So beware the LMI mortgage trap. Now, I'm not going to get into too much detail about this today. I've decided that I'll do a detailed video on this next week, but I'll just touch on it briefly just now so you know what I'm talking about. So LMI, what is that? That's Lender's Mortgage Insurance. So you are required to take out lender's mortgage insurance if the loan to value of your property is 80% or greater. Okay. Now, if that is the case, this means that you're in line for a very expensive lender's mortgage insurance premium to pay when you remortgage. And these are in the thousands. They are quite expensive. So you're going to end up being faced with two choices. One is paying that LMI if you're in this situation, and potentially adding that to your loan. That's usually an option, but then you pay interest on that for over the long term, so it tends to be a very expensive option. Or you just stay on the default standard variable rate that your fixed rate mortgage is going to default to, which is not the greatest idea either. But if you're in this situation, you could end up in this trap. Sadly, many people this year with fixed rate mortgages are going to get caught in this trap. But there are some ways to work it. Well, next week in next week's video, I'm going to get into the details to work out if you're at risk of this trap, how to work that out, and particularly in this market of declining home values, and what you might be able to do about it. So I'll get into the detail of that in next week's video. I won't do that today. But anyway, that's it from me today. I hope you found that really interesting. Just recapping, know when your fixed rate's ending, Know what repayment increase you're going to be in for. Work out if you can afford that increase. Try and find some savings, some margin. Get prepared for this because it's coming for you. Look at, get proactive. Look at how you may be able to renegotiate or refinance the current loan you're on. And that last thing I just talked about, when it comes to renegotiating or in particular refinancing, if you're going to get caught by that LMI mortgage trap. Talk about that next week. All right, so I hope you've enjoyed that today. I hope you got great value out of it. If you have, please share this with others that you feel will get great value out of it. Subscribe to my channel, whether you're on Facebook or YouTube hearing this. And of course, like the video and watch any of those other videos in the links in the descriptions that I provide to you today. I'm sure you'll get great value out of those as well. Thanks very much. Thanks for spending your time with me today, and I'll see you next week. Bye for now.